If you showed a chart of gold's performance over the last few years to a traditional investor from the 1990s, they wouldn't ask you about interest rates. They wouldn't ask you about supply chains. They would ask you, so when exactly did World War III start? Because historically, gold is the bunker asset. It is the financial equivalent of canned beans and a shotgun. It is what you buy when you think the world is about to end. It is supposed to be boring. It is supposed to sit in a vault and do nothing, like a pet rock that happens to hedge against currency debasement. But lately, gold has been acting less like a pet rock and more like a tech stock on steroids. It is hitting all-time high after all-time high, ignoring every rule in the economics textbook. Usually, when interest rates go up, gold goes down. It is basic math. Why hold a shiny metal that pays you zero interest when you can buy a treasury bond that actually pays you a yield? But recently, rates went up and gold went up with them. The correlation broke, the math stopped mathing. So we have to ask the uncomfortable question. Is the market broken? Or does the market know something that we are desperately trying to ignore? Now, if you ask your uncle at Thanksgiving why gold is expensive, he'll point to the price of eggs and say, it's inflation, obviously. And sure, inflation is the easy answer. It feels right. Our money buys less, so we need more of it to buy the yellow metal. But if we look at the data without emotional bias, that explanation falls apart. In 2022, when inflation in the US hit 9%, literally the highest in 4 decades, gold actually traded sideways. It did nothing. If gold was purely an inflation hedge, it should have gone to the moon right then and there. But it didn't. It waited. It was not until inflation started cooling down that gold started heating up. So, blaming this entirely on the price of groceries is lazy analysis. It is like blaming rain on the fact that you washed your car. Yes, they happened at the same time, but one did not cause the other. We need to look deeper. We need to find the whale. In financial terms, a whale is an entity with so much money that when they enter the pool, the water level actually rises for everyone else. And right now, there is a massive whale swimming in the gold market, and they are trying very hard not to make a splash. Who buys gold by the ton? Not you, not me, not tech companies. It is central banks. The literal architects of the fiat money system are currently the biggest buyers of the hard asset that competes with their own product. According to the World Gold Council, central bank buying has reached levels we haven't seen since the 1960s. We are talking about over 1,000 tons a year. But why? Why would the People's Bank of China, the Reserve Bank of India, and central banks from Poland to Singapore suddenly decide they need vaults full of bullion? It comes down to a concept called counterparty risk. For the last 80 years, the global financial system has run on a simple premise. The US dollar is as good as gold. Actually, it's better than gold because it pays interest via treasury bonds. The world parked its savings in US debt because it was the risk-free asset. But in 2022, something changed. When the United States froze the dollar assets of a major G20 nation due to geopolitical conflict, a light bulb went on in the headquarters of every central bank around the world. The realization was this: United States treasuries are not risk-free. They are political risk heavy. If you aren't on friendly terms with the United States, your savings account can effectively be deleted overnight. So, these countries aren't dumping the dollar in a panic. That would destroy their own economies. Instead, they are doing what I call the silent exit. They are slowly, methodically putting their new profits into an asset that cannot be frozen, cannot be sanctioned, and has no counterparty risk. If you hold a United States bond, you are relying on the United States government to pay you back. If you hold a bar of gold, you don't need to trust anyone. The gold is the value. In a world where trust is evaporating, gold becomes the only neutral currency left. This leads us to the weirdest part of the current economy, the paradox. Traditionally, markets operate like a seesaw. Side A, everything is awesome. Investors buy stocks, real estate, and tech. They sell gold. Side B, the world is burning. Investors sell stocks. They buy gold and bonds. But look at the screen right now. The S&P 500 is at all-time highs. AI stocks are valued as if they are going to cure mortality next Tuesday. Investors are euphoric. And gold is at all-time highs. Central banks are bracing for impact. How can both be true? How can we be in a golden age of tech and a financial doomsday prep scenario simultaneously? It's because smart money is playing a game called the Barbell Strategy. On one end, they are chasing the AI bubble because they have to. FOMO, the fear of missing out, is a powerful drug, and liquidity is still sloshing around the system. They want to ride the wave of technological productivity, but on the other end, they are terrified of the debt required to fuel that system. The United States national debt is growing by $1 trillion every 100 days. The interest payments on that debt are now higher than the entire United States defense budget. The market is effectively saying, we bet that technology will change the future, but we also bet that the currency we use to price that technology is being debased. It is like wearing a life jacket while sitting at a blackjack table. You are betting big on winning the hand, but you are also dressed for the ship to sink. It looks ridiculous, but given the macro environment, it might be the only rational strategy left. So, what does this mean for us, the regular people who don't run central banks? It means we need to stop looking at gold as just a trade. It's not about buying low and selling high next week to buy a PS5. The price of gold is a fire alarm. When it rings this loudly, even when the party in the stock market is booming, you should not ignore it. The entities that control the printing press, the ones who can create infinite dollars, euros, and yen, are choosing to trade their own infinite paper for finite metal. They are telling you, without saying a word, that they prefer the one asset they cannot print. The global south is diversifying. The BRICS nations are hoarding. The geopolitical landscape is fracturing. The dollar isn't dying tomorrow, but its absolute monopoly is ending. We are entering a new era of fiscal dominance, where governments have to print money to pay their debts, regardless of inflation. In that world, holding something tangible is not paranoia. It is insurance. You don't buy fire insurance because you want your house to burn down. You buy it because if it does, you don't want to be left holding nothing but ashes. I'm curious to hear your take. Are we in a new supercycle for hard assets, or is this just one giant fake out? Let me know in the comments. And remember, watch what the big players do, not just what they say. See you in the next one.